What's going on, everybody? This is Joey from Universal CPA Review. We're going to spend some time going through the 5-step revenue recognition model that is outlined by Revenue Standards ASC 606. Ultimately, this is something that is tested at a high level on the FAR exam, but it is something that you should be aware of so that you can pick up easy points on the multiple choice questions on your exam. Keep in mind, this is also something that you could very easily see in a task-based simulation. So while I'm not going to sit here and tell you that this is the most intuitive information at first glance, there is an easy way to simplify this, and that's what we're going to do. And before we dive into it, I just want to remind you to subscribe to our YouTube channel and join any of our Facebook study groups. If you like what you see and want to give Universal CPA Review a try, feel free to utilize our free 14-day trial, which will provide you with access to all of our course content. If you do want to commit to our program and purchase lifetime access to any of our course products, feel free to utilize discount code UNIVERSAL2021 at the checkout for 25% off. Alrighty, let's learn what's up with these 5 steps. Here we go.
Okay, so now talking about ASU 2014-09, which is the FASB literature for revenue recognition. And this is an interesting accounting standard, specifically for companies that work in long-term contracts, right? So a good example of this is always going to be in the construction industry, right? It's always going to have an impact in the construction industry because these are generally going to be long-term projects. Okay, so generally a lot of moving parts going on here. This is not a performance obligation that's just going to be satisfied overnight. Okay, these things take time. So with the new accounting standard, we can now break out revenue recognition based on these contracts over a 5-step process. And what's really compelling about this is it allows firms to break out the transaction into separate performance obligations within the contract. And revenue will be recognized based on each independent performance obligation. Whereas in the past, we would have had this completed contract method that basically says that revenue would be recognized once the contract is complete. But now we have this recognition of revenue over time. Okay, and we're not doing this based on the overall cost incurred like we could have under the percentage of completion method. We're now going to be doing this based on the separate allocated performance obligations. Okay, but instead of just reading words, let's introduce you to our music festival production company called Get Stupid. Interesting choice of name, but hey, if it caters to the audience, then well, whatever works, right? So the process of putting on these music festivals is quite elaborate. It's not just a snap of the fingers and voila, right? This is going to take time and it's going to take a lot of different elements to this contract. But the first step to the 5-step approach has already been cleared by Get Stupid, right? They have identified the contract with their client. So this is going to be the city that wants to put on the music festival to increase tourism, hospitality, right? All that good stuff. So step number 1 is complete related to this 5-step approach. They've identified the contract with the customer. And now step 2 is where things get important for Get Stupid. They need to now identify separate performance obligations within the contract. This is essentially saying that this is a liability that they are incurring for generating this revenue, right? Revenue isn't free. It's going to need to be worked for. So this is now going to be broken out into different components. All right. So we have 5 different components that we're going to allocate these separately stated performance obligations to. Okay. So in the real world, it could be a lot more than 5, but just to keep things simple, we're going to go with 5 performance obligations. Okay. So Get Stupid is going to use their performers to put on the show. They're going to charge the city for putting up the staging. They're going to do all the lighting, and they need a strong sound setup so that everybody can hear the music. Okay, and they're also going to do additional site development. This could be things like excavation, right? Additional building, all things of that nature. So now that Get Stupid has a thorough understanding of the separate performance obligations, they can now determine the transaction price. And this makes sense, right? Because now that they understand how much work the company needs to do, they can now identify how much they should charge to make it worth their while. So let's say that they quoted $20 million to put on the music festival, right? This is going to be a crazy event. So now they can move on into step 4, which is how they're going to be recognizing this revenue, which is going to be based on allocating the price to the performance obligations in the contract. So if of these 5 performance obligations, let's say we're going to allocate $3 million to the performers. Let's say they charged $4 million to the staging, $3 million to the lighting, $2 million to the sound setup, and $8 million to the development. Okay, so now revenue has properly been allocated to the separate performance obligations within the contract. And revenue will ultimately be recognized based on when those separate performance obligations are satisfied. And once again, this is different than how it used to be. If the company instead elected to use the completed contract method or the performance of completion method, revenue would instead be recognized when the contract was complete or as cost was incurred. Okay, not going to be the case under the new 5-step standard. We're now going to be allocating the transaction price to the performance obligations within the contract. Alrighty then, now that we understand the 5 steps involved in the 5-step revenue recognition criteria at a very high level, we can now dive into the details of each of these steps. Okay, keep in mind, this is one of those topics that has a very realistic chance of only testing your knowledge of this information at a very high level. But with that being said, sometimes the difference between passing and failing just comes down to understanding the intuition. So it's always worth it to go the extra mile and spend the additional time understanding each of these steps in more detail. So as we mentioned, step 1 is identifying the contract with the customer. So in our example, we're saying that this is when the local city has entered into a contract with Get Stupid to put on those music festivals. Okay, so thinking about what is required for a contract to be considered enforceable. So the first question I have for you is, do contracts need to be written in order to be considered binding, aka enforceable? The answer is no, they do not. Okay, so contracts can be written, they can be made orally, or they can be implied. All right, but what about what makes a contract enforceable? What makes this qualified as a binding contract? So it has to meet the 5 criteria. Okay, so first and foremost, the parties of the contract have approved the contract. Okay, so both parties have agreed to the terms of the agreement. So now it's up to the party that is selling to get this done. Okay, so the next step is the entity can identify each party's rights regarding the goods or services that are being transferred. So a good example of this is if one party has the right to terminate the contract. Right? If one party has the right to terminate that contract with no penalties, then this is something that should be known, right? In which case, no contract would be enforceable at all. This is not a contract by definition. If we enter into a contract and I don't have to do anything I said I was going to do, by definition, this isn't binding. All right, at least for revenue recognition purposes. The third one is going to be that the entity can identify the payment terms for the goods or services that are being transferred. Okay, so payment terms must be identifiable. So basically we're just saying that as long as we have enough information to determine the transaction price, then we're golden. Okay, so the terms can be whatever it is that we agree to. If they say that they're going to pay us up front, that should be stipulated. If they say they're going to pay us at the very end of the contract, should also be stipulated, but it should be known. Okay, so the contract has commercial substance. Right, so in other words, there has to be a valid business reason for this transaction. Okay, so we'll talk more about commercial substance when we get into our non-monetary transactions lecture a little bit later on, but basically this is going to be essentially when a business transaction is expected to have future cash flows. Okay, so if there's no commercial substance, then that would be a problem for recognizing revenue. An example of this would be if Get Stupid sells one of their assets to its sole owner and then immediately leases it back to the company to generate revenue from the sale. Right? If the owner's like, I have this brilliant idea, I'm just going to sell this to myself, inflate income, and then lease it back to myself. Right? They're going to be like, yeah, that's definitely not revenue. Okay, and finally, collectability has to be considered probable. Okay, so this is important for a few reasons. If we don't think we're going to collect on the contract, what's the point of entering into the binding contract? Okay, so the rule here says that we should at least think that these people are going to be able to afford to pay us if they're signing off on the contract. Okay, so when we are identifying this contract, this is the 5 criteria to make a contract considered identifiable and enforceable. Okay, so let's go through an example. Okay, so back to Get Stupid. On January 1st, year 1, Get Stupid Inc. entered into a written contract to put on a music festival for the Sleepy Town's most popular event. Okay, so they're going to do this for $4 million. Get Stupid is responsible for the staging, the lighting, and bringing on its performers, which will cost the company a total of $2.8 million. While the event will be completed and ready for use on October 1st, year 1, Sleepy Town is going to pay them the full amount on September 1st, year 1. Okay, so we got to record the journal entries that Get Stupid will book when accounting for this transaction. 3 implications here. We have when the contract was entered into on January 1st, year 1. This is not going to recognize anything, all right? So no entry would be required. And the reason is because neither party has yet performed its respective obligations. We're not going to recognize anything until the obligation has been performed. Okay, so what's happening on September 1st, year 1? On September 1st, year one, cash is coming in. Okay, so although the event isn't going to be ready for use until October 1st, Sleepytown is paying them the full amount on September 1st. So we're going to debit cash for $4 million, but this is revenue that has not yet been earned. So we would credit unearned revenue for that same $4 million amount. Okay, so what about October 1st? Now the work has been completed. For all intents and purposes, the revenue has been earned. All right, so we're going to reverse out that unearned revenue because it has now been earned. Okay, so now we're going to credit the revenue that has been earned. Okay, so related cost of goods sold is also going to need to be booked. Right, this isn't a 100% margin. We're selling services, but we're also selling goods. Right, that staging, the lighting, the sound systems, everything involved in this is going to be our inventory. So Get Stupid is going to debit the cost of goods sold amount for $2.8 million. That's the total cost. And they're going to credit inventory for the same $2.8 million. All right, so again, this is an example of an enforceable contract. Right, if we look at the information again, we see that the first criteria is met. We know that both parties agreed to this contract. They entered into a written contract. We see that in the first line. It's pretty clear that services are getting transferred, or we know that Get Stupid is responsible for the staging and the lighting and the implementation of all of that while bringing in the performers. Okay, so we also know that there are payment patterns. We know that Get Stupid is going to get paid on September 1st, year one. How about commercial substance? Does this have commercial substance? Yes, it does. This is a pretty straightforward business transaction, right? And there's nothing in here that indicates that there's any reason to believe that Get Stupid is not going to get paid, okay? So collection is going to be considered probable. All right, so that's what we need to know about step one, identifying the contract. Let's move on into step two. Okay, so thinking back on step two, which requires that we identify and separate the performance obligations within the contract. So thinking back on Get Stupid's performance obligation. Okay, so ultimately what they're getting paid to do is put on this music festival. So what's important to note is that this is a project that requires multiple performance obligations within the contract, right? So they're going to get the performers, they're going to put up the staging, the lighting, okay, and they're also going to do that sound setup and develop the site. So once the enforceable contract has been entered into, what we're going to do now is separately identify each identifiable good or service involved in this contract, and make sure that they are considered distinct from one another. Okay, so if there are multiple performance obligations, then this is going to require the separation of those obligations. Okay, so when we have a performance obligation, this is going to be a promise to transfer to the customer either a good or service, but a good or service that is considered distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer. Right, so if we're thinking about staging versus lighting versus site development, these are all very distinct from one another. So therefore, they're going to be provided and will likely be invoiced separately. So they're going to meet the criteria of being distinct goods or services. Okay, so if the good or service is not considered distinct, then we must ask ourselves, is this capable of being distinct? So let's stop right there. What does it mean to be capable of being distinct? This can also be thought of as separately identifiable. The definition of this is that a customer could benefit from a good or service if the goods or services could be used, consumed, sold for an amount that is greater than the scrap value or otherwise held in a way that generates an economic benefit. Okay, so let's translate. Basically, we're saying here that this is distinct if the good or service that is being provided or sold can provide benefit to the buyer on its own. Right, so if the city was purchasing just the lighting or just the staging, those both provide value on their very own. Right? Could you make the argument that technically the lighting couldn't be used without the stage? Are they interrelated? Sure, but that's why we call it capable of being distinct. So what happens if goods or services are not distinct or are not even capable of being distinct? A good or service that is not distinct should be combined with other promised goods or services until the entity identifies a bundle of goods or services that are distinct. Okay, so just remember, no non-distinct good or service gets left behind. Okay, so some of the miscellaneous details that we need to consider are going to be the types of consideration included in the price. Okay, so those 4 types of considerations that we're going to include in the price will consist of variable consideration, non-cash consideration, financing components, and consideration payable to the customer. Right, essentially what we're saying is that these are the miscellaneous details that might be included within the terms of the contract. All right, so starting off by thinking about variable consideration. So ASC 606 basically allows for two methods for estimating variable consideration. Okay, so they're going to allow for the expected value as well as the most likely amount. Okay, so a company will generally choose the method that it'll provide the best estimate of the amount that it will be entitled to. So when we're dealing with the expected value, this is an approach that will be used to find a range of possible consideration amounts. We're essentially going to weigh these amounts by their respective probabilities and then sum up the probability weighted amounts to generate one single amount that will represent the expected value of consideration to be received from the customer. The most likely amount is essentially the transaction price for the contract that is most likely to be received. All right, so when would we use this method? This would work well in situations when there are two possible outcomes. So if one of the two real possibilities exists, using the expected value approach would likely result in a transaction price that is significantly different than either of the two possible outcomes. All right, so the most likely method is generally going to be the more appropriate method because it will generally produce a better estimate of the consideration that the company expects to receive. All right, but this would be tough to do when there is an outcome that is not significantly more likely than the other. All right, so your quick hitter takeaway for variable consideration is that this is contingent on a future event. So an example of this could be like a bonus. All right, so the next consideration would be non-cash considerations, right? It's not always that the transaction price would be valued in cash, right? What if this was a barter agreement? I'll give you this if you give me that, right? At the end of the day, a transaction price is the consideration that the entity expects to receive in exchange for goods or services, and will be recognized at the fair value amount of that consideration. Okay, so ultimately when a customer pays with non-cash consideration, the fair value of that consideration may not always be as clear as a cash payment, right? The value of this property might be a little bit subjective. Okay, so in which case, judgment might be needed to determine the fair value of the consideration offered. Okay, so a good example of this could be publicly traded stock. That's property that is easier to determine than, say, equipment or an intangible asset. In those cases, we would need to use a lot more judgment. Okay, so the next consideration is financing components. The transaction price isn't always going to be one lump sum. This could be financed with either debt or equity, in which case we might need to also consider interest. Okay, so if there's a bulk prepaid amount, or the majority of this is paid after the goods or services are provided, then the transaction may contain a significant financing component. Okay, so this might be beneficial to those that are selling what it is they're selling, right? Especially if they are receiving this in advance. All right, we don't need to worry about collecting it at this point. And finally, consideration payable to the customer. If the consideration that is paid or is payable to a customer is a discount or a refund for goods or services provided, then the reduction of the transaction price should also be recognized. Right? At the end of the day, companies can make payments to their customers for a variety of reasons. These payments will relate to the sales transaction from an entity to the customer. In some cases, the entity can purchase goods or services from one of its customers. So an example of this could be things like coupons or rebates. Okay, so questions that the entity should consider to properly account for consideration payable to a customer can consist of the following. Does the payment fall into the scope of this guidance? Does this entity receive a distinct good or service in exchange for the consideration payable? Can the fair value of the distinct good or service be determined? Is the consideration payable higher than the fair value? Okay, so as we said, discounts or refunds on goods or services provided is a good example of what we're talking about when we think about consideration payable to the customer. All right, making some progress. We're now digging in to step 4. And we remember that this is the allocation of the transaction price to the performance obligations within that contract. Okay, so this transaction price will be allocated using the relative standalone selling price method. Okay, but however, the standard will include 2 exceptions, which would be allocating discounts and allocating variable consideration. Okay, so many contracts will require companies to fulfill multiple performance obligations. Okay, so within this step 4 of the 5-step revenue recognition process, this will require that entities allocate the transaction price to each performance obligation in proportion to its standalone selling price. Okay, so the standalone selling price is ultimately going to be the price that the company would sell this good or service
to a customer. Okay, so think of this as the individual selling price. Okay, so the best example of standalone selling prices would be the price that the company charges for goods or services in a separate transaction with a customer. Okay, but however, sometimes goods or services are sold exclusively as a package combined with other goods or services rather than on an individual basis. Okay, so hint, hint, customer support. Okay, so sometimes this is going to be an add-on to incentivize somebody to purchase the product package. Okay, so let's think of this example. A car dealership is going to sell that sports car, but they're also sometimes going to recognize as a separate performance obligation future unspecified maintenance or upgrades relating to the vehicle. And that would all be bundled within that price, right? Maybe you get unlimited oil changes. In this case, the standalone selling price must be estimated. Okay, so that's more generally thinking about the standalone selling price, right? And as we said, there are two exceptions, allocating discounts and allocating variable consideration. Okay, so thinking about discounts, and let's get back to Get Stupid's $20 million contract that we're allocating based on the different performance obligations, right? $3 million to the DJ, $4 million to staging, $3 million to lighting, $2 million to the audio sound setup, and another $8 million to the construction of the rest of the site. Okay, so for recognition purposes, these are separate services, right? They're ultimately different obligations within the total consideration of the contract. So again, this needs to be allocated proportionally to all obligations within the contract. Okay, but now let's say that this contract is going to come at a discount. Okay, so in order to entice the township to go with Get Stupid, they're going to offer the entire bundle at $18 million, not the full $20 million. Right? They're saying, why don't you make this a one-stop shop and let us do everything from music to staging to lighting to audio to construction, right? We'll take care of all 5 of these areas and we'll also give you that $2 million discount to go with us. Okay, so we're going to charge $18 million instead of $20 million. So what we need to do is we need to allocate that $2 million discount proportionally to each obligation within the contract. So for example, the entertainment makes up 15% of the total obligation, the staging 20%, another 15% to the lighting, audio is allocated 10%, and site development makes up 40% of the entire obligation. Okay, so therefore, the $2 million discount would be allocated respectively and recorded for financial reporting purposes based on these percentages. Okay, so if we were to record the journal entry for Get Stupid's receipt of service revenue on February 1st of the current year, we would debit the cash for $18 million, right, the proceeds received. Service revenue music would get credited at $2.7 million, which is 15% of the total consideration. Staging would get its 20% at $3.6 million. Okay, the lighting, another $2.7 million, which is 15%. Audio's 10% at $1.8 million. And the site development made up 40%. Okay, so we would credit service revenue site development for $7.2 million. But more broadly, you see here that this is getting allocated based on its total consideration percentage. Okay, so quickly touching on variable consideration once again, right? This is something we talked about in step 3, and we're going to briefly touch on it once again in step 4 of the revenue model. Okay, so there are different processes for variable consideration, but that's not what you need to know for the exam. Big takeaway here is what we talked about in step 3, right? When you're thinking about variable consideration, think of this and immediately relate this to bonuses, right? At the end of the day, the bonus could have an impact in the total allocation of this contract price. All right, making some progress. We're now digging in to step 4. And we remember that this is the allocation of the transaction price to the performance obligations within that contract. Okay, so this transaction price will be allocated using the relative standalone selling price method. Okay, but however, the standard will include 2 exceptions, which would be allocating discounts and allocating variable consideration. Okay, so many contracts will require companies to fulfill multiple performance obligations. Okay, so within this step 4 of the 5-step revenue recognition process, this will require that entities allocate the transaction price to each performance obligation in proportion to its standalone selling price. Okay, so the standalone selling price is ultimately going to be the price that the company would sell this good or service to a customer. Okay, so think of this as the individual selling price. Okay, so the best example of standalone selling prices would be the price that the company charges for goods or services in a separate transaction with a customer. Okay, but however, sometimes goods or services are sold exclusively as a package combined with other goods or services rather than on an individual basis. Okay, so hint, hint, customer support. Okay, so sometimes this is going to be an add-on to incentivize somebody to purchase the product package. Okay, so let's think of this example. A car dealership is going to sell that sports car, but they're also sometimes going to recognize as a separate performance obligation future unspecified maintenance or upgrades relating to the vehicle. And that would all be bundled within that price, right? Maybe you get unlimited oil changes. In this case, the standalone selling price must be estimated. Okay, so that's more generally thinking about the standalone selling price, right? And as we said, there are two exceptions, allocating discounts and allocating variable consideration. Okay, so thinking about discounts, and let's get back to Get Stupid's $20 million contract that we're allocating based on the different performance obligations, right? $3 million to the DJ, $4 million to staging, $3 million to lighting, $2 million to the audio sound setup, and another $8 million to the construction of the rest of the site. Okay, so for recognition purposes, these are separate services, right? They're ultimately different obligations within the total consideration of the contract. So again, this needs to be allocated proportionally to all obligations within the contract. Okay, but now let's say that this contract is going to come at a discount. Okay, so in order to entice the township to go with Get Stupid, they're going to offer the entire bundle at $18 million, not the full $20 million. Right? They're saying, why don't you make this a one-stop shop and let us do everything from music to staging to lighting to audio to construction, right? We'll take care of all 5 of these areas and we'll also give you that $2 million discount to go with us. Okay, so we're going to charge $18 million instead of $20 million. So what we need to do is we need to allocate that $2 million discount proportionally to each obligation within the contract. So for example, the entertainment makes up 15% of the total obligation, the staging 20%, another 15% to the lighting, audio is allocated 10%, and site development makes up 40% of the entire obligation. Okay, so therefore, the $2 million discount would be allocated respectively and recorded for financial reporting purposes based on these percentages. Okay, so if we were to record the journal entry for Get Stupid's receipt of service revenue on February 1st of the current year, we would debit the cash for $18 million, right, the proceeds received. Service revenue music would get credited at $2.7 million, which is 15% of the total consideration. Staging would get its 20% at $3.6 million. Okay, the lighting, another $2.7 million, which is 15%. Audio's 10% at $1.8 million. And the site development made up 40%. Okay, so we would credit service revenue site development for $7.2 million. But more broadly, you see here that this is getting allocated based on its total consideration percentage. Okay, so quickly touching on variable consideration once again, right? This is something we talked about in step 3, and we're going to briefly touch on it once again in step 4 of the revenue model. Okay, so there are different processes for variable consideration, but that's not what you need to know for the exam. Big takeaway here is what we talked about in step 3, right? When you're thinking about variable consideration, think of this and immediately relate this to bonuses, right? At the end of the day, the bonus could have an impact in the total allocation of this contract price. Okay, and finally, digging into step 5, which is the ultimate revenue recognition. And this is going to be recognized once the obligation has been performed, right? We're talking about accrual accounting. Revenue is going to be recognized when earned. All right, so in other words, revenue will be recognized once the obligation has been satisfied and the customer has retained possession of the goods or services. Okay, so if this is a prepaid amount, right, the obligation hasn't been performed yet, it's going to be performed at a later date, we're now going to have to recognize unearned revenue. Okay, and the revenue portion will be recognized once it has been earned. All right, so in which event the liability would be reversed and the revenue would be recognized. So what defines a performance obligation being satisfied? This is going to occur when the entirety of the transaction or the obligation has been transferred to the customer or client. Okay, so it is completely satisfied once the goods are delivered or the services are completed. Okay, so when it comes to goods or services, they will be considered to have been received once they have obtained control of the asset. So the next question I have for you is, how can we determine whether or not control of the asset exists? Basically, this is going to occur when the customer has achieved some sort of economic benefit, right? If we're buying goods, we can now put the goods to use. If we obtained a service, the service actually provided us with that value. Okay, so this can either be satisfied by way of a one-time lump sum payment, or it can also be done periodically. Okay, so as we see in this visual, if revenue is being recognized periodically, it's going to be recognized over time. Okay, so let's say that this revenue is earned between the months of January and April. While we will be recognizing revenue monthly as the obligation is being fulfilled, the satisfaction of the obligation won't be recognized until April, when the services are performed in its entirety. Okay, so if we're thinking about control being passed to the customer, we should consider the following to determine whether or not the transfer has occurred. 1. The entity has a present right to payment for the asset or service. The customer has legal title to the asset. Physical possession has been transferred to the customer. Significant risks and rewards of ownership have been transferred to the customer. And finally, the customer has accepted the asset. Okay, so thinking about the presentation of this recognition in the financial statements. At this point, we know that revenue is getting recognized, and at times there will be situations where unearned revenue is being recognized. But something you might not have been aware of is the fact that we'll also have a balance sheet impact that we need to consider. Okay, so we're going to focus on both contract liabilities and contract assets. Contract liabilities and contract assets will be reflected on the organization's balance sheet when agreed upon contracts are entered into. Generally, contract liabilities are going to end up being reported by the company that has entered into the agreement and will perform the terms of the contract. Right? This is the performance obligation. So when a company like Get Stupid agrees to perform services or deliver goods and receives payment prior to doing so, then they're going to have this contract liability that will be on their books until the obligation to perform the services or deliver the goods have been fulfilled. Right? This is no different than the association of unearned revenue. Although we receive that prepaid cash, we still have this obligation to fulfill. If, on the other hand, Get Stupid goes ahead and delivers the services and provides the goods prior to receiving payment, then it will book a contract asset on its balance sheet. Okay, this is going to reflect the company's future right to compensation, right? Think of this essentially as an accounts receivable. Something else that is a little bit minor to note is the difference between conditional or unconditional rights. Okay, so these are two types of contract assets. Okay, so for example, if the company has recognized this contract asset because it has already fulfilled the contract obligation, but it's still required to perform other obligations before it is entitled to payment, it would be considered conditional. Okay, whereas if it is unconditional, then they're not going to have to perform any other further obligations. They're simply just going to await payment. Taking a look at this example, Get Stupid is entering into a cancelable contract with singer Young Money on January 1st, year one. Okay, so Young Money is going to be receiving $1,500 in advance on February 1st, year one. Okay, and the company promises to transfer a product to the customer on March 1st, year one. Okay, so on February 1st, year one, the customer is advancing the company $1,500. All right, so we're recognizing the cash received in the amount of $1,500, but we still have to deliver that product to the singer. Okay, so the contract liability of $1,500 is what is getting credited. This is the obligation we still must fulfill. So there's still going to be this balance sheet impact. So when they do go ahead and make this transfer on March 1st, year one, they're going to thereby satisfy the performance obligation. So we're going to reverse that contract liability of $1,500, and the revenue has now been earned. Let's now say in example number 2, the same facts, only now we're saying the contract becomes non-cancelable on January 15th, year one. Okay, so on January 15th, year one, we're going to record the receivable that has an unconditional right to consideration. Okay, so we're still going to record that contract liability that is going to be credited, but now only we're going to be debiting a receivable of $1,500, not cash. Okay, so when we do go ahead and collect the $1,500 on February 1st, year one, we would now record the cash received of $1,500. Okay, so we would reverse that receivable, it's getting credited, and we're going to debit the cash received of $1,500. All right, but we're not going to transfer the product, as we said, until March 1st, year one. So we're not going to satisfy this performance obligation until this date. It is now that we would debit the contract liability of $1,500 and credit revenue of $1,500. All right, so we're not going to recognize this revenue until the contract obligation has been fulfilled. Okay, and finally, on January 1st, year one, the company enters into a contract to transfer product one and perform service one to a customer for a total consideration of $2,250. Okay, so it looks like we have multiple performance obligations. The contract requires product one to be delivered first, and that payment will not be made until service one is performed. Okay, so we're going to conclude that the delivery of product one and the performance of service one are separate performance obligations. And furthermore, we're going to allocate $1,500 to product one and $750 to service one based on the analysis and historical data. Okay, so we're going to take a look at the journal entries yet again. And the first entry would be to record the satisfaction of the performance obligation to transfer product one. Okay, but we remember that the contract requires product one to be delivered first and that the payment will not be made until service one is performed. So we're going to be dealing with some contract assets. Okay, so we know that the delivery of product one and the performance of service one are separate performance obligations. So when it comes to recording the delivery of product one, we're going to record a contract asset for the $1,500 amount, and we're going to go ahead and record revenue, right? We're going to record revenue because it has been earned. Just because we're still awaiting payment doesn't mean we haven't fulfilled the performance obligation, right? We delivered product one. Whereas when it comes to the satisfaction of the performance obligation to perform service one, it is now that we're going to recognize revenue for service one. We can still record the entire receivable for the entire expected amount, right? We're expecting $2,250. So we're awaiting payment. We're going to record the receivable of $2,250. We're still going to record the contract asset that we are now recognizing from the delivery of product one. Okay, so $1,500 is still going to get recognized as a credited amount, right? That makes up a part of that receivable, and we're going to credit revenue for the delivery of service one now. Okay, so revenue from this service would now be recorded.